What if I told you that over the next 30 years, you are likely going to buy your mutual fund manager a luxury vacation?
Like every single year.
Yeah, exactly. Every single year. You're going to pay for their flights, their premium hotels, their dinners out, and you are going to fund all of it using your own retirement savings.
Right. But the most brilliant part of this entire arrangement, you will never actually write them a check.
Today, we are looking at the invisible drain in your portfolio. Welcome to another deep dive.
It's really the ultimate stealth tax on your future. The financial industry has basically perfected the art of taking a cut so quietly that, most investors don't even realize their long-term wealth is just bleeding out.
It's wild. So today we are looking directly at the massive, often overlooked impact of investing fees, and more importantly, how you can actually structure your portfolio to escape them.
Completely escape them.
Right. And we are pulling from a massive stack of sources today to do this. We are synthesizing financial analysis from NerdWallet, The Motley Fool, Morningstar, Bankrate, JP Morgan Asset Management.
We're even digging into some foundational academic papers by William F. Sharpe.
Yeah, heavy hitter stuff. The goal here is to help you truly understand expense ratios. We want you to witness the staggering, terrifying mathematical impact these fees have on your wealth over time.
And then we're going to look at the strategies and the actual top 10 lowest cost funds that are currently dominating the market.
Okay, so let's start with a basic assumption a lot of us have.
Yeah.
Because it feels, incredibly intuitive.
Yeah.
If I hire a master chef, I expect a better meal. If I hire a master carpenter to build a table, I expect a better table than if I bought one flat-packed from a store. I am paying a premium for human expertise.
Right, that makes total sense.
Following that logic, it feels completely natural that I should pay a premium for a highly educated professional fund manager to actively pick my stocks for me. If they are the professionals, studying the market all day, they should get me better returns.
It is a totally rational expectation. But the stock market doesn't really function like a carpentry shop or a restaurant. To understand why that intuition fails us, we have to look at William F. Sharpe's famous paper, The Arithmetic of Active Management.
Okay.
He essentially dismantles the whole idea of the premium stock picker, and he does it using pure, unavoidable math.
Okay, let's unpack this. How does math disprove the value of a professional stock picker?
Well, Sharpe points out a structural reality of the market. Before any costs are factored in, the average actively managed dollar and the average passively managed dollar, they have to yield the exact same return.
Wait, the exact same.
The identical return. Because, think about it, the aggregate stock market is simply made up of all the active investors and all the passive investors combined.
Oh, I see.
So if the passive investors are just holding the market average, then the active investors collectively must also equal the market average.
So it's less like hiring a carpenter and more like, I don't know, a fantasy football league. It's a closed loop.
That's a perfect way to look at it.
Like, for every active manager who cleverly buys an undervalued stock and wins, another active manager had to sell them that stock at a loss. They're literally just trading money back and forth.
Exactly. It is a zero-sum game before market growth. So before we even talk about fees, the average active manager is tying the average passive index fund.
Right.
But here is the fatal flaw for the active manager. They have immense overhead.
Oh, yeah. The luxury offices.
Yeah, they have to pay for teams of analysts, high-speed trading terminals, corporate offices, and of course, their own hefty salaries.
Whereas a passive fund.
Or passive fund just runs an automated computer algorithm to track a list of stocks. That's it.
Right.
So because the active dollar has mathematically identical gross returns to the passive dollar, but carries significantly higher operating costs, the active dollar is guaranteed to lose after those costs are deducted.
That is just brutal math. Which brings us to the actual cost itself. We need to clearly define the enemy here. What exactly is an expense ratio?
So an expense ratio is simply the annual cost of owning a fund. It's measured as a percentage of your total investment.
Correct.
It is the fee the fund management company charges you every single year just to hold your money. And the reason it is so dangerous is that, like we said earlier, it feels completely invisible.
You don't get an invoice in the mail.
No, you don't. They just quietly skim it off the top of the fund's net asset value.
And just to clarify that term for anyone who might not be familiar, the net asset value, or NAV, is literally just the total value of all the underlying stocks the fund holds on any given day, divided by the number of shares.
Right.
So the fund company takes their percentage out of that total pool, before you ever see your daily account balance update.
Exactly. They take their cut internally. You only ever see the net return, which totally masks how much you're actually paying them.
And this is where the math gets genuinely terrifying.
It really does.
When you look at the data provided by Bankrate and Intellectia AI, you see how this seemingly tiny percentage creates just a devastating drag over decades.
Yeah, let's walk through the psychology of it.
Yeah, because a 1% fee, it sounds like a rounding error. It sounds like a penny on the dollar. Who cares, right?
Right.
But let's say you invest $10,000 and the market grows at a standard historical rate of 7% a year for 30 years.
Okay.
If you are in a passive fund with a tiny 0.1% fee, your investment grows to roughly $72,000.
Which is the magic of compounding interest working in your favor.
Exactly.
Hmm.
But if you take that exact same $10,000, growing at the exact same 7% market return, and you are paying a 1% fee, which, by the way, is incredibly common for active mutual funds,
Oh, very common.
your final balance only reaches $57,000. You lose $15,000 over those 30 years.
It is vital to pause on that number. You invested $10,000. You lost $15,000 to fees.
Wow.
You have surrendered more than your entire original investment to the management company.
And the larger your portfolio grows, the more brutal the raw dollar amount becomes.
Oh, definitely.
Say you invest consistently over your career, and you hit a major milestone. Say your portfolio reaches $1 million.
A great milestone.
But a 1% expense ratio means you are paying $10,000 every single 12 months.
Yep.
That is the luxury vacation. You are handing them 10 grand a year to run a computer program or to actively pick stocks that statistically won't even beat the market.
And the statistics on that are sobering. Over a 20-year period, our sources show that 93.42% of active fund managers fail to beat their benchmark, like the S&P 500 index.
93%.
Right. You are paying a premium price for a 93% chance of underperforming a simple automated index.
It's just unsettling. It makes you realize that a 1% fee doesn't mean you lose 1% of your wealth. It means you lose a massive chunk of your final compounding power. So if these ratios are the ultimate enemy of long-term growth, let's look at the solutions. Because our sources pull the top 10 lowest cost funds available right now. And what really stands out isn't just the specific ticker symbols, it's the broader industry trend.
Yeah, we are in the middle of a massive price war.
We absolutely are.
Yeah.
And the consumer is the clear winner here.
If we look at the list of the top 10 cheapest funds highlighted across our data, the biggest insight is the zero-fee revolution.
Here's where it gets really interesting.
Yeah, this kicked off in 2018 when Fidelity decided to offer funds that cost literally nothing. And platforms like E-Trade followed suit. Out of the top 10 cheapest funds on the market right now, 6 of them have an expense ratio of 0.00%.
They aren't skimming a single penny. You keep 100% of the return.
$0.00.
Yeah.
And you are getting full market exposure. First off, you have the Fidelity Zero Large Cap Index Fund, ticker FNILX.
Right.
And their Total Market Index Fund, FZROX, both of which have recently posted one-year returns hovering between 15 and 18%.
That's incredible for zero cost.
It really is. Then you have their zero-fee extended market fund, FCIPX, for mid-cap stocks, and even an international fund, FCILX, tracking foreign companies. That one has seen recent one-year returns over 34%.
Wow.
And E-Trade offers similar funds, their no-fee total market index fund, ETTOX, and their large cap index fund, ETLGX, both sitting right at that beautiful 0.00% mark with recent returns over 30%.
So that first tier of 6 funds is entirely free. What about the rest of the top 10, the giant legacy funds?
The remaining 4 funds do charge a fee, but it is microscopic due to the intense competition between financial giants like Vanguard, State Street, and Charles Schwab. We're talking about expense ratios of 0.015% or 0.02%.
I mean, to put 0.015% in perspective,
Yeah.
if you invest $10,000, you are paying them $1.50 a year.
It is essentially free. So rounding out the top 10, we have the Fidelity 500 Index Fund, FXAIX, at 0.015%. Then the Schwab S&P 500 Index Fund, SWPPX, and the State Street SPDR Portfolio S&P 500 ETF, SPYM, both at 0.02%.
And the final one.
The most prominent example here is the Vanguard Total Stock Market ETF, ticker VTI. It charges just 0.03%. 3%. And what is staggering about this specific fund is its scale.
Oh, yeah.
It's the largest fund in the entire world. It holds over $2.09 trillion in assets, giving investors exposure to over 3,500 different U.S. companies.
$2 trillion.
Uh-huh.
Let that sink in if you were listening to this and wondering how to start. The accessibility of wealth building today is just unprecedented.
Truly.
The biggest fund in the world costs practically nothing, and there's an entire tier of funds that literally cost zero.
Yeah.
But I am naturally skeptical.
As you should be.
Right? There's an old saying that there's no such thing as a free lunch.
Mhm.
If Fidelity and E-Trade are charging exactly 0%, what's the catch? Are we locked into some sort of walled garden? How are they making money?
What's fascinating here is that you're right. There are catches. They're certainly not running a charity. There are two main trade-offs you make when you enter that zero-fee ecosystem.
Okay, what's the first one?
The first is custodian lock-in.
Meaning you are trapped on their platform?
In a sense, yes. You can generally only hold a proprietary zero-fee fund in that specific broker's account. So if you buy the Fidelity Zero funds, you must keep them at Fidelity.
Right.
If 5 or 10 years down the line you decide you want to move all your investments over to, say, Vanguard or Schwab, you cannot simply transfer those specific shares. You are forced to liquidate them. You have to sell them for cash, move the cash, and then buy new funds at the new brokerage.
And if the market has gone up over those 10 years, selling them means you suddenly trigger a massive capital gains tax bill.
Exactly.
Your entirely free fund could suddenly cost you thousands of dollars in taxes just because you wanted to change websites.
That is the trap. Now, the second catch relates to how they legally avoid charging you in the first place. Normally, if a fund wants to track the S&P 500, they have to pay a licensing fee to S&P Global to use their exact list of companies and their exact formula.
Oh, I've never thought about that.
Right, it costs money to use the name. To bypass that licensing fee, the brokerages create their own proprietary knockoff indexes. They're usually very close to the official index, but they aren't identical.
So they build a list that looks a lot like the S&P 500, but they tweak it just enough to avoid copyright.
Precisely. And this can lead to subtle concentration risks. Some of these zero-fee total market funds end up heavily weighted toward a single sector.
Like tech.
Yeah, for example, the FCROX fund is nearly 32% information technology. You think you are buying the entire broad market, but you are actually taking on a fairly concentrated bet on Apple, NVIDIA, and Microsoft.
Interesting. So if being locked into a mutual fund can trigger a tax bomb when you try to leave, how do we avoid those tax bills? This feels like a perfect transition to the structural difference between traditional mutual funds and ETFs, exchange-traded funds.
The structural difference is profound, and the research from JP Morgan Asset Management highlights an aspect of traditional mutual funds that often shocks investors. Basically, you can be taxed for other people's behavior.
Walk me through the mechanics of that.
Yeah.
Because that sounds awful.
It is. Let's imagine you and I both own shares in the exact same traditional mutual fund. You decide you want to cash out and buy a house, so you sell your shares.
Okay, so I hit sell.
To give you your cash, the mutual fund manager often has to sell some of the actual underlying stocks the fund holds. Maybe they sell some Google shares.
That makes sense. They liquidate the stock to hand me the cash.
But if they sell those underlying stocks at a profit, it triggers a capital gains tax. And here's the brutal part. That capital gains tax liability is distributed across the entire mutual fund.
Wait, really?
Yes, it is passed on to everyone still holding shares. So, I am investing for the long haul. I haven't sold a single thing, but I suddenly get hit with a tax bill at the end of the year because you decided to sell your shares.
That is infuriating. You have absolutely no control over it.
You don't, and it happens even in bad markets. The JP Morgan data points out that in 2022, which was a rough year, where the broader market lost around 18%.
Oh, I remember.
Yeah, well, over 42% of active mutual funds still distributed capital gains that year.
So investors watched their portfolio values plummet and then received a tax bill on top of it.
Purely because other panicked investors were selling?
A leaky bucket inside a leaky bucket. So how do ETFs solve this problem?
ETFs use a brilliant logistical workaround called an in-kind transfer. They don't deal in cash when shares are created or redeemed. Instead, they operate through large institutional middlemen called authorized participants.
Okay, how does that work?
Think of it like trading a basket of groceries instead of selling the groceries for cash.
Okay, I like that analogy.
If an ETF needs to redeem shares, the manager doesn't sell the apples and bananas for cash to hand back to the investor. Instead, they just hand the entire physical basket of apples and bananas over to the middleman, in exchange for the ETF shares. Because there is no actual cash sale of the underlying stock by the fund itself, no capital gains tax event is triggered inside the fund.
Oh, that is incredibly elegant. It bypasses the taxable event entirely, so ETFs are vastly more tax efficient.
Vastly.
You are only ever paying capital gains taxes when you personally make the decision to hit the sell button on your own ETF shares.
That is the core advantage. You are insulated from the actions of your fellow investors.
So synthesizing all of this, if a massive ETF, like the Vanguard Total Market Fund, gives you access to 3,500 stocks, avoids the mutual fund tax trap, and charges an essentially invisible fee of 0.03%, is that the ultimate answer?
Well,
Like, should an investor just buy that one fund, hold 3,500 companies, and assume they are perfectly safe and perfectly diversified?
it is really tempting to think so, but the answer is actually no. Right. Yeah. Simply holding more individual stock tickers does not automatically equal true safety or diversification. The sources from The Motley Fool feature a debate that highlights this exact illusion. The reality is that the market is incredibly top-heavy.
Right.
The S&P 500, which is just the 500 largest companies, already accounts for about 80% of the entire U.S. stock market's total value.
So adding those other 3,000 smaller companies in a total market fund barely moves the needle. They are just a drop in the bucket compared to the giants.
They barely make an impact, and the concentration risk at the very top is reaching historic levels. We have to talk about the Magnificent Seven.
Right. Apple, Microsoft, NVIDIA, Amazon, Meta, Alphabet, and Tesla.
Exactly. Right now, those 7 companies make up roughly 33.3% of the entire S&P 500.
A third of the market in 7 stocks.
Just to show you how fast that happened, back in 2016, they only made up about 12.5%.
That's crazy. So even if you own 500 companies or 3,500 companies, your financial future is heavily dictated by the daily performance of a tiny handful of massive tech giants.
Yep.
If the tech sector faces a prolonged downturn, your supposedly diversified portfolio is going to take a heavy, heavy hit.
Which leads us to how you actually achieve structural diversification. This is where the sources point to the Boglehead philosophy.
John Bogle.
Right, named after the legendary founder of Vanguard. He was actually laughed at by the industry when he first introduced the retail index fund in the 1970s.
Really?
Oh, yeah, Wall Street called it Bogle's folly because they couldn't understand why anyone would settle for average market returns instead of trying to beat it.
And now his philosophy dictates trillions of dollars. So what is the core Boglehead approach to fix this tech concentration?
It centers on simplicity and capturing the entire global market, usually through what's called a 3-fund portfolio. You don't just hold U.S. stocks. The first pillar is your U.S. index fund. The second pillar is an international ETF.
Okay, like what? Something like VXUS, which charges a tiny 0.05% fee, but gives you exposure to over 8,000 foreign stocks. So you get emerging markets and European economies.
Spreading the risk across borders. So if the U.S. economy has a stagnant decade, but international markets are booming, you are protected.
Exactly. And the third pillar is a broad bond fund, like AGG or BND. Bonds act as the structural shock absorbers for your wealth.
Right, because when the stock market crashes, bonds tend to hold their value or even increase.
Right. They provide true diversification because they move differently than equities. By balancing those 3 simple, ultra-low-cost funds, you own a piece of global capitalism without betting on any single sector.
It's a remarkably clean strategy. But before we wrap up, our sources also issued some stark warnings.
Yes, very important warnings.
We've talked a lot about what to buy, but there are some absolute landmines hiding in the market that we need to point out.
Yeah, the data highlights a category of very unattractive style funds. And it shows that egregious fees are not a thing of the past.
Give me an example.
They specifically point to funds like the Northern Lights Issachar Fund, ticker LionX, which charges a total annual cost of 7.53%.
7.53% a year.
Yes.
We established earlier how a 1% fee destroys your compounding interest. 7.5% is mathematically crippling.
Think about it. If inflation is running at 3% and your fee is 7.5%, your underlying investments have to generate over a 10% return every single year just for your purchasing power to break even.
Just to break even.
It is a mathematical impossibility over the long term.
The bottom of the bucket hasn't just leaked, it has completely fallen out.
Right.
What was the other major trap the sources warned about?
The Motley Fool strongly advises long-term investors to avoid heavily leveraged ETFs, such as a 2x S&P 500 fund.
These are the funds that promise to double the daily return of the market, right? Like if the market goes up 1%, the fund goes up 2%.
Yes, but the key word there is daily. To achieve that doubling effect, the fund managers have to use complex financial contracts derivatives, and they have to take on debt.
Okay.
This creates a hidden trap called volatility decay, or an inherent downside bias.
How does volatility decay actually work in practice? I mean, it sounds bad, but what is the math?
It comes down to the math of recovering from losses. If a normal index drops 10% from $100, it's at $90.
Right.
To get back to 100, it needs an 11% gain. But a 2x leveraged fund drops 20% down to $80. To get back to 100, it doesn't need 22%. It needs a 25% gain.
Oh, wow.
Because of how they use debt to reset their leverage every single day, the internal drag will slowly eat your capital in a choppy market, even if the underlying index eventually goes up over a long period.
So they are tools meant for day traders holding for a few hours, not for retirement accounts holding for decades.
Exactly. Stay far away for long-term investing.
So, synthesizing everything we've uncovered today, high fees are not just an annoyance. They are a mathematical certainty that will drain your compounding wealth over time.
Mathematically guaranteed.
The active fund manager selling you the illusion of a gourmet stock-picking meal is almost always going to deliver less value than the automated, boring index fund.
Yes.
But the silver lining is that you are investing in a golden age. You have access to zero to low-cost index funds, highly tax-efficient ETFs that shield you from the panic of other investors, and elegant, simple strategies to diversify your money across the globe.
The power has entirely shifted to the individual investor. It's amazing. But looking at all this data does raise a fascinating, almost paradoxical question to leave you with.
Oh, what's that?
Well, if passive investing is so clearly mathematically superior, and it continues to grow so popular that eventually everyone abandons active managers and just buys these low-cost index funds, who is left to actually set the prices of the underlying stocks?
Oh, that is a wild thought.
Mm.
Because passive index funds buy automatically. They don't read balance sheets or care if a stock is fundamentally overvalued or undervalued. They just blindly buy based on the company's size in the index.
Exactly. If nobody is doing the hard, active work of valuing companies, does the entire stock market eventually become one giant blind follower?
Right.
And if true price discovery breaks down because the whole world is passively indexing, does that create massive inefficiencies? Inefficiencies that, ironically, a new generation of active managers might one day exploit to finally start beating the market again.
The ultimate paradox.
Mhm.
If passive investing wins completely, it might break the very market efficiency it relies on to work.
It is a theoretical breaking point that economists are watching very closely as index funds continue to swallow the market.
Well, until that theoretical day arrives, I think the action item is clear. You need to check your own portfolio for those invisible holes. Take 15 minutes, look up the expense ratios on your current funds, and ask yourself who is really getting rich off your investments, you or the management company.
Great advice.
Thank you for joining us on this deep dive. Keep asking the hard questions, keep patching those leaks, and we'll see you next time.